the U.S. economy has defied a lot of expectations for this year. And we think that as we move into the end of this year, it will probably stay in positive territory, but it's on a very slippery slope. Primarily what we've seen driving growth this year has been Capex spending on AI-related investments, as well as some volatility around surges in imports and then the reduction in imports, and that had everything to do with the trade negotiations this year. But when we look at the biggest part of GDP, and that is the consumer, sounds like a broken record, but we continue to think the consumer is very stretched here. We have real wages that are stagnating because inflation continues to be a problem, even though the markets wouldn't tell you that it is. But you're also looking at the labor market that is weakening. We've had a very solid labor market from the pandemic. Well, we are seeing signs of weakening, which is why the Fed has cut interest rates. But you're also seeing investors that are worried about their financial situation. They're worried about inflation. When you look at this chart, you can see that from the University of Michigan Consumer Sentiment Survey, they looked at the percentage of those that they surveyed that expect their financial situation to be worse in the next 5 years. That's at a record high. That has everything to do with inflation that just continues to compound year after year. Now, we think the Fed will continue to cut rates. We are in the middle of a government shutdown, so we're not getting a lot of data, but they will continue to cut interest rates this year. 2026 is still on the table because we don't know from an inflation standpoint if this inflation situation is going to get worse. It's proven to be sticky. When you look at this chart, it's also reversing course. You can see that the Fed's preferred inflation indicator is moving a bit higher every month now. This is not something you hear in the headlines, but we surely know this when we look at asset allocation because the equity markets are not factoring in this risk. Inflation is very difficult to get from that 3% level down to that Fed's target. So while the Fed will cut interest rates to support the economy for the remainder of this year, the next year, 2026, it still is a very unclear picture.